Welcome back to FactorWave. Today we're going to look at how we apply factors to futures. As well as finding predictive factors for stocks, researchers have found predictive factors for futures and commodities as seemingly diverse as agricultural commodities, metals, and oil have been shown to have commonalities, and we can use these to construct a profitable futures trading strategy. Again, we go to the derivatives section of the website and come down to the futures strategies page. We have three futures strategies. The first one is a time series momentum strategy. We can find more about the strategy by clicking on the information button, and we see the particular references that we've based our implementation on. Time series momentum is fairly simple in that we buy things that have been going up and sell things that have been going down. Here we can see the instruments we're trading, the direction of the position, and the size of the position. The size here is based on a notional account value of $100,000. Now obviously this is a large account, and it also means that we can't always trade an integer number of contracts. Some of these contracts are very large. For example, here we would want to be short 0.73 corn futures. Obviously that's not possible. The way I implement this is to round to the nearest one unit. Now, if you've got a bigger account, for example, a $1 million account, we would do 7 futures here. The universe of instruments we look at are all the futures listed on Eurex, the CME, and the ICE. Now, not all people will have access to all of these instruments, and not all people will want to trade all of these instruments. When we constructed this portfolio, we didn't assume that we were putting in any instrument purely for diversification purposes. So all of these should make money on their own. It would be entirely possible, for example, to just trade corn and to be short right now. But if you combine all of these into a portfolio, we can look at the results down here. This is the cumulative P&L of the strategy, starting with a notional $100,000 account in 2000, and is now worth roughly $5 million. We can also look at shorter periods, just as we could with the VIX. The second strategy we have is a term structure momentum strategy. This is similar to one of our VIX strategies and is based on the idea that the term structure itself is predictive. In particular, the spot value of a commodity is more predictive of its future value than the future value is. And this strategy has run from $100,000 to about $810,000. Now, in addition to running each of these strategies separately, we've combined them. By that I mean we're looking for things that have the same sign in both strategies. So for example, here, if NYMEX heating oil was short, and it was also short in our previous strategy, we would go short in the consensus strategy. The consensus strategy is good because it typically trades far fewer individual commodities at a given time. It makes it easier to implement. And this is the cumulative P&L of the consensus strategy. So this was an introduction to the FactorWave futures strategies. Again, this can be used either as a standalone model or as the basis for your own trading. Be sure to look at the references that we've provided, and we'll also have white papers and blog posts on this coming up. Thank you.